Index funds have turned thousands of everyday investors into millionaires, and what's great about them is they've got this built-in simplicity that makes them feel like the easy button for investing. Just buy a few, then chill. And on paper that's true. Index funds are simple, they're proven, and built for long-term success. But what's rarely talked about is how easy it is to mess them up. Because even with something as straightforward as index funds, there are still a few hard truths that you only learn after you've been doing it for a while or after you've already been burned. Just so we're clear, when I say index fund throughout this video, I'm referring to both a traditional index fund as well as the ETF version of an index fund. If there's one misconception I hear over and over again, it's that all index funds are basically the same. But they're not. When most people hear index fund, they picture something that automatically owns the entire stock market. But the truth is, index just means that the fund tracks something, and what it tracks could be totally different from what you think. There are thousands of indexes out there. Some track the S&P 500, some track small cap growth stocks, others track specific sectors like energy or tech, and some even track bizarre combinations of factors that sound like something that you would order off of a Mexican restaurant menu.
Angus rice sounds like a Mexican dish. Maybe we should put her on a plate and send her to Mexico so the Mexicans will eat her.
So when you see the word index on a fund, it doesn't mean you are buying the same thing everyone else is. You could be holding something super broad and balanced, or something very narrow and risky without even realizing it. I once looked at someone's portfolio who proudly said that he was fully diversified. He had the S&P 500, a large cap growth index fund, and a total US stock market fund since it sounded very diverse. Except every single one of those funds was holding mostly the same 100 companies. All he was really doing was doubling down on them. This kind of overlap happens all the time because fund names are confusing on purpose. Total, growth, value, core, advantage, and enhanced all sound good, but in many cases, they're just rebranded ways to sell you the same stuff. Even if you understand that overlap is an issue, another problem is picking the wrong index fund for the right reason. Take this example. You want broad exposure to the entire US stock market, which is a great goal. So you buy a small cap index fund, a mid cap index fund, and a large cap index fund, thinking you've built a balanced mix. But what you've really done is create a Frankenstein version of something that already exists. A single total US stock market fund that does all of that automatically. Now, I'm not saying that there is never a case for splitting a total US stock fund into small, mid, and large cap funds if you're skilled enough to justify it. But honestly, I don't even bother with that complexity, and I'd bet that most DIY investors are better off keeping it simple. More moving parts just means higher cost and more chances to accidentally mess everything up. And that's what a lot of investors don't realize. The idea is right, but the execution isn't ideal. You're trying to reinvent something that's already been optimized to work better than your DIY version. I like to call it index fund over-engineering. It's what happens when people turn something designed to be simple into a grad school science project. The good news is that once you understand this, everything gets so much simpler. All you need is a few funds that actually cover the market. That's why I'm a huge fan of a two-fund portfolio. One total US stock market or S&P 500 fund, and one total international stock market fund. That's it. A few weeks ago, I was working with a newer investor, helping him get all of his ETFs and index funds in order across his different accounts. As we were working through everything, I was talking them up like I normally do, mentioning the low costs, the diversification, and the simplicity. And I had to catch myself, because the more I talked, the more I started making these things sound like they were completely risk-free. And that is just not true. Yes, index funds are one of the most powerful tools an investor can use to build wealth, but they still live and die by these same stock market gods everyone else does. When the market drops 30%, your index funds drop 30% as well. And that's where a lot of people get blindsided. They buy into index funds expecting a smooth ride because they've heard people like me talk about how great they are and show all of these fancy schmancy historical charts going up and to the right and think, hey, that looks pretty safe. Take a look at this chart from JP Morgan. It shows every single year since 1980. Those gray bars represent each year's total return for the S&P 500, and the red dots show how far the market dropped within that year. What's wild is that in almost every single year, even the really good ones, the market still fell at some point. On average, the S&P 500 has dropped about 14% within the year every year for the last 4 decades. You can see it right there. Years like 2013, the market finished up around 30%, But at one point that year, it still dropped about 6%. In 2020, it was down more than 34% during the COVID crash, but still finished the year up 16%. And yet, despite those swings, the market ended higher in 34 out of 45 years. So when your portfolio falls 10 or 15% during the year, that's not a sign something's broken. As crazy as it sounds, it's normal. That chart is proof that volatility and risk are something that you should expect, as opposed to something that you should try to avoid. I like to look at it as the price you pay for long-term returns that come a lot later in life. Just like the price you pay for lifelong friends is waking up hogtied when you fall asleep around them in high school. No? No one else? Just me and my friends? Okay, let's move on. Here's the thing. The market isn't what keeps most investors from building wealth. It's how they react to it. If you zoom out, history's pretty clear. Every crash, every correction, and every bear market eventually fades into the background. But in the moment, it doesn't feel like a minor dip. It feels like the end of the world. Heck, I just saw this play out again in early 2025. Back in April, when all of those tariff shenanigans hit the headlines, the market dropped nearly 5% in a single day. One of the biggest one-day drops that we've seen in a while, and people lost it. Now, as an index fund investor, that kind of thing isn't anything to be worried about. The market was reacting to a bunch of noise, and within weeks, it started bouncing back, just like it always does. But it was a perfect reminder that the hardest part about investing isn't what the stock market is doing, but our reaction to it and how we handle our emotions. I could show people 100 charts proving that the market always recovers, but the second that they see their portfolio drop just a few percentage points, logic goes completely out the window. You can own the best performing index funds in the world, but if you can't sit still when things get ugly or weird, then none of it matters because your returns are going to suffer. It reminds me of Adam Sandler's character in the movie Uncut Gems. He was a degenerate, compulsive gambler who was always getting himself into bad situations because of his constant poor decisions. The dude could not stop getting in his own way, which made the movie extremely painful and annoying to watch. I actually hated the movie because of it. Now, the easy part is buying the index funds. The hard part is surviving your own emotions long enough to let compounding do its job. And it isn't just something that I have noticed anecdotally. JP Morgan recently analyzed the behavior of more than 10 million retail investors and found that most people still invest emotionally. When markets go up for a few months, investors pour money into them, which is classic return chasing. And when volatility spikes, a wave of dip buyers rush in, hoping to time the bottom. Together, those two behaviors of chasing and reacting explain almost 40% of all swings in the monthly investment flows. Basically, we invest based on what just happened instead of what actually matters, which is time in the market. And the investors who figure that out and stop trying to outsmart the market end up being the ones who win. Here's the irony most index fund investors never think about. Our entire strategy depends on someone else not following it. Index funds don't decide what a stock is worth. They just buy whatever sits inside the index in proportion to its market value. The ones who set the prices are all the traders, hedge funds, and overconfident stock pickers out there fighting each other every single day trying to beat the market. They're the ones analyzing earning reports, timing trades, overreacting to headlines, and in the process, they keep prices accurate. That process is called price discovery, and it's what allows index funds to simply ride the market instead of trying to guess it. So as much as we like to poke fun at the gamblers and the active traders, we secretly need them to keep the market efficient for us. If everyone suddenly became a passive investor, the system would break. Prices would stop adjusting, new information wouldn't get reflected, and we'd all be sitting around owning a market that no longer actually works. Here's the truth about index funds that surprises most people. They're built to give you average returns, and believe it or not, that's their superpower. Now, there are times when index funds can perform extremely well, hence what we've seen recently, even above the historical average, which we've seen recently. But whatever return they give you are the average returns at that point in time. Index funds don't try to beat the market, they are the market. So by investing in them, you're basically saying, I'll take whatever the market gives me. That means your long-term returns will match what the market produces minus a tiny bit of fees. And that's where a lot of people get it twisted. They hear that index funds beat most investors and assume that that means they'll outperform everyone. But what that really means is index fund investors simply don't underperform like everyone else does. John Bogle, the founder of Vanguard and the godfather of index fund investing, said it best: "Don't look for the needle, buy the haystack." Most people waste their lives trying to find the needle, like the next hot stock, the next hot fund, or the next trend, and they end up bleeding returns along the way. The Bogle heads call this the beauty of being average. You're not swinging for home runs. You're just quietly hitting singles every year, and that's what compounds into real wealth. The true mindset shift, though, is that since index funds give you average returns, which are unpredictable year to year, it forces you to focus on the part of investing that you can control. You can't control whether the market gives you 4% or 14% this year, but you can control how much you invest, how consistently you add to it, how much risk you take on, the fees, how long you stay in the game, and your behavior. And that's where the real power comes from. The investor who keeps adding money during good markets and bad ones will consistently outperform the ones who chase better returns but cannot stay disciplined. I love showing my car investing fund to drive this idea home. Check this out. From May 2021 to October 2022, the S&P 500 dropped about 8%. A brutal ride for most investors. But my account, made up of index funds, barely budged and stayed flat for 17 months. Not because I'm some genius investor who knows how to avoid losses, but because I kept investing $275 every month no matter what was happening. When the market tanked, I bought more shares at lower prices, lowering my average cost and keeping my account balance flat. That discipline turned a losing market for me into a sideways one, which shouldn't be looked at as a bad thing. I was set up perfectly for when the market recovered, since those cheap shares turbocharged my gains. That's the power of focusing on what you can control and not worrying about the things that you can't, like returns. So yeah, index fund investors' returns are average by design, but if you master your behavior and your contributions, your results will be anything but average. Can you guys hear my dog snoring behind me? Do you hear that? What's not immediately obvious when you dive into index fund investing is that you're buying into a philosophy. This philosophy isn't some ancient rule book handed to you when you buy your first index fund. It's a mindset built on simplicity and discipline, where success comes from refusing to play the game of outsmarting the market and instead focusing on staying invested long enough to win by default. The mechanics are straightforward. Buy low-cost funds, build a simple portfolio, hold it, and let the market work over time. But the real test is mental, something that followers of Vanguard founder Jack Bogle have preached for decades. It demands a sort of stoic detachment where you ignore market swings, meme stock insanity, or your cousin's guaranteed stock tip. It's about resisting the urge to chase random stock surges or panic sell during crashes that go completely against your own instincts. Most beginners miss this. They think that it's about picking the right fund. In reality, the fund is almost secondary. The real challenge is sticking to the plan for decades by doing nothing when every impulse in your body screams at you to do something. Study after study shows the same thing. Investor behavior, not fund choices, is the biggest performance killer. The truth is that anyone can buy an index fund, but it takes an almost unnatural level of patience to stay calm during the chaos. If you can't stomach a 30% drop without panicking, or if FOMO gets you when others brag about their gains, you're gonna crack. The philosophy isn't just buy and hold, it's buy, hold, and don't care. That's what you sign up for, and if you can't live with that, no fund is gonna save you. Earlier in the video, I mentioned my car investment fund. If you want to know how it all worked out after running the experiment for over 10 years, then watch this video to your left next. Hit that like button before you go and share the video with someone you think needs to see it. I'll see you in the next one, friends. Done.